Brad Williams, Frugal Finance, hedging import-export transactions. Consider a novel trade where a small import-export business is negotiating a significant purchase of Japanese watches from a Japanese company. When the watches are delivered, the Japanese company demands payment in yen, shifting the exchange risk to the buyer in the face of a formidable negotiator. The price that was agreed upon today is 2850 yen per watch, with a total of 15,000 watches to be purchased. The total amount owed in 7 months is approximately 42.75 million yen. With reference to Table 918, which shows the exchange rates in effect as of April 11th, converting at the current spot rate of $0.004173 per yen results in a purchase price of $178,396. Nonetheless, given that December futures are trading at 0.004265 on the same day, an examination of future price indicates that a decline in the value of the dollar relative to the yen is anticipated. Consequently, if delivery and payment take place in December, the actual dollar outlay may be closer to 182,329 than the initial estimate of 178,000. The importer chooses to use foreign exchange rates trading as a unique means of hedging the transaction against any negative fluctuation in the exchange rate. The importer chooses the December futures deliberately in order to avoid having to keep rolling over adjacent contracts and to reduce transaction costs, with delivery scheduled for November. Additionally, the December contract has the benefits of being in close alignment with the hedge horizon, which could reflect the spot exchange rate that is common in November when the yen is about to be dispersed. So here we have a spot price of 0.04173. We have a June, September, and December futures foreign exchange rate. Here's the foreign exchange rate. The subsequent challenge from the importer is based on the futures contract standard denomination, which is 12.5 million. The importer struggles to balance the contract size with the actual transaction volume needed, deciding on 3 contracts to cover 37.5 million. Now he's looking at buying 42.75 million, and because these are set contract size, you can see he's short. The question is, does he buy 4 contracts, or does he just do a partial hedge and just take the 3, leaving a portion of the exchange risk unhedged? The importer debates whether to take 3 or 4 contracts. Table 919 shows that as of April 11th, the importer estimates that 4.275 million will be needed. This translates to a current dollar value of 178,396 and an estimated future value of 182,329 based on December's futures cost. The importer's decision to purchase 3 December yen contracts at 0.04265 right here per yen in the futures market was influenced by the estimated future price, which is the key performance indicator for assessing the hedge's performance. The importer uses spot market transactions to purchase yen at a rate of 0.04273 upon the arrival of the watches on November. He just bought the stuff back at the going rate, 40273, upon the arrival of the watches in November. This results in an unexpected expense of 342 over the estimated cost. The importer then proceeds to liquidate their position in futures, but since there's only been a tiny movement in the futures market of 0.00005, the profit is only 187. As a result, there's a $155 loss on the entire transaction. So here it is, April 11th. The importer anticipates a need for 42 million in November and by current value of 178,396, which has an expected value in November of 182,329. The importer buys 3 December yen futures contract at 0.004265 for a total commitment of 159,938. Receives watches, he just buys this back at the spot market rate of 0.04273 at a total of 182,671. Sells 3 DEC yen future contracts at 160. Spot market results. Future market equals negative 187. 182,329. That's what he sold. He bought it back at 182,671. 342. The net loss was $155. This results emphasizes the hedge's partial success for two main reasons. First off, there's a clear difference in how cash and future prices move. The former moves by $0.00008 per yen, while the latter moved by $0.0005 per yen. Second, the importer's transaction volume is insufficient to cover the entire required amount, which prevents them from fully hedging their position. Yen 525 million of the exposure is unhedged, with futures trading for 37.5 million and demand for 42.75. Those are the hurdles when you're trying to build a hedge strategy. There are other ways he or she could have hedged this, but this is a good introduction. This is just a very simple approach done, daily by many treasurers or companies in order to protect themselves against crazy old movements in interest rates and exchange rates and dollar and foreign currencies. It's not something you take lightly. This is why there are professionals in the industry that do this day in and day out. They have black boxes, if you will. In other words, you may be one of those financial analysts that may be working on the black boxes, working with clients, hedging. You may be a hedge expert, and all you're going to do, you have algorithms. You're going to have black boxes. You're just going to crunch the numbers, and it's going to say, you're going to buy 3 contracts here, and then you're going to buy 7 XYZ options, or you're going to sell them, or what have you. Or maybe you can figure out some kind of swap, 4-month swap, or what was this, 6-month swap, or something to that effect. That's the creative side of finance. There are endless products, and every product is generally created by some finance person, and that finance person is going to train you on how to sell it. Brad Williams, Frugal Finance.